Imagine this scenario. You are 63 years old. You have spent your entire working life, 4 decades, maybe even more, building toward retirement. One evening you settle into a chair at your kitchen table, pull up your retirement account statement, and go through your contribution history. Everything looks reasonable. You feel like you have been responsible, like you have done what you were supposed to do. But then something catches your eye. A limit, a number printed right there on the page, and it is lower than what you were actually permitted to contribute. You could have deposited thousands more, thousands of dollars shielded from taxation, quietly compounding for your future. But no one ever told you that option existed. And now you have just turned 64, and that opportunity is permanently gone. That is not a worst-case scenario invented to frighten you.
That is the lived reality of workers all across this country right now. The IRS opened a 4-year window, and age 63 was your final opportunity to walk through it. My name is Dexter. I work as a senior policy analyst, and my area of focus is retirement, finance, IRS regulations, and the policies that shape your financial life after the age of 50. Today I am going to walk you through a rule the IRS put into effect beginning in 2025, one that treats workers between the ages of 60 and 63 differently from every other age group in the retirement savings system. And age 63 is the most critical year within that window, because it is the last year this elevated benefit applies to you. I'm going to show you the precise law, the exact dollar figures straight from IRS publications, and the specific errors that are causing people to forfeit thousands of dollars they will never be able to recover. But I also need to alert you to something before we finish. There is a hidden trap built into this rule, one that does not merely affect how much you are able to save, but can actually bar you from making any additional contributions whatsoever. I will cover that in full before this video ends, so please stay with me all the way through. If you're somewhere between 55 and 65, or if someone you care about is, the next 12 minutes may be the most financially consequential time you spend today. Let me introduce you to Robert. Robert is 63 years old. He works as a manufacturing supervisor in Ohio and has been with the same company for 38 years. He is a dependable man who has honored every financial obligation throughout his adult life. Robert has a 401k plan. He began contributing to it back in his 30s, and when he crossed the age 50 threshold, he started making catch-up contributions. The additional amount the IRS permits older workers to deposit on top of the standard annual limit. Every single year, Robert maximized those contributions. He put in the regular deferral amount. He put in the catch-up amount on top of it. He operated under the conviction that he was doing everything correctly. And for the majority of his career, he genuinely was. But here is the piece of information Robert never had. In 2025, a significant new rule took effect under legislation known as the Secure 2.0 Act. The IRS established a special elevated catch-up contribution ceiling, but it applies exclusively to workers who turn age 60, 61, 62, or 63 during the calendar year, not 59, not 64, only that specific 4-year window. Robert turned 60 in 2022, which meant he was 63 in 2025. That was his final year inside the eligible window, but his company's payroll department never updated their system to reflect the new provision. They continued applying the old standard catch-up limit, the same figure they calculate for every employee over the age of 50. So what exactly did Robert lose? In that single year alone, he missed out on an additional $3,150 in tax-sheltered retirement savings. And when you add up the missed opportunity across all the years he was 60, 61, and 62, the total amount he left sitting on the table across that entire window approaches $13,000. Money that should have been growing inside his account compounding on a tax-advantage basis, building toward his future. Now Robert is 64. He reached out to his HR department and asked whether there was any mechanism to recover what he had missed. They gave him an honest answer. There is no such mechanism. The window is permanently closed. The IRS does not permit carry-forward contributions. There is no provision that allows you to retroactively fill in what was not deposited when it should have been. Robert did everything he believed was right, but a single rule he never heard about cost him more than $13,000, and he only discovered it after the door had already shut behind him. Now let me show you precisely what this rule says. No second-hand information, no guesswork, just the official legislation and the verified dollar amounts published by the IRS. The legislation in question is the Secure 2.0 Act, Section 109. On December 29, 2022, the Secure 2.0 Act was signed into law. It contains 92 separate provisions affecting retirement plans across the country. But Section 109 is the one that matters most for this conversation. Section 109 amends Internal Revenue Code. Section 414V, the specific portion of the federal tax code that governs catch-up contributions, meaning the supplemental amounts workers are permitted to contribute once they reach age 50. What Section 109 did was establish an entirely new elevated tier within that framework. The IRS refers to this as the enhanced catch-up contribution. Many financial professionals in the retirement planning space call it the super catch-up. It applies exclusively to individuals who turn age 60, 61, 62 or 63 during the calendar year in question. This provision became active on January 1st, 2025, and the IRS published its finalized regulatory guidance on September 16th, 2025 in the Federal Register. Now let me give you the precise dollar amounts for 2026. The standard contribution ceiling for deferrals into a 401k, 403b, governmental 457b, or thrift savings plan is $24,500. That baseline applies to every eligible participant, regardless of age. Beyond that, if you are age 50 or older, the IRS allows an additional catch-up contribution. For 2026, that standard catch-up amount is $8,000. This means workers between the ages of 50 and 59 can contribute a combined total of $32,500 annually. But if you fall within the 60 through 63 age bracket, your catch-up contribution ceiling is not $8,000. It is $11,250. That brings your total permissible contribution up to $35,250 for the year. Let me lay this out with complete clarity so there is no confusion. Workers between ages 50 and 59 have a catch-up limit of $8,000, giving them a total contribution ceiling of $32,500. Workers between ages 60 and 63 have a catch-up limit of $11,250, bringing their total ceiling to $35,150. And workers who are 64 or older see their catch-up drop right back down to $8,000, identical to what someone who is 52 years old is permitted to contribute, with a total ceiling that returns to $32,500. This means age 63 is definitively your last opportunity. It is the final year during which you can take advantage of this elevated limit. Once that year passes, the door does not simply narrow, it closes completely, and the IRS provides no mechanism to carry forward any unused contribution room from this window. This is what I refer to as the age 63 cliff. Your catch-up capacity drops from $11,250 to $8,000, a reduction of $3,250, effective the moment your birthday moves the calendar forward by a single year. Now here is where the situation grows considerably more complex. Beginning January 1st, 2026, a second regulation has been layered on top of everything I have just described. It originates from Section 603 of the same Secure 2.0 Act. If your FICA wages in 2025 exceeded $150,000, then every catch-up contribution you make during 2026, without exception, must be designated as a Roth contribution. That means after-tax dollars rather than pre-tax dollars. Now, Roth contributions are not inherently unfavorable. The money in a Roth account grows entirely free of taxation. And when you take distributions in retirement, you owe nothing to the IRS on those withdrawals. But here is the trap that is catching people completely unprepared. If your employer's retirement plan does not include a Roth contribution option, then you are legally prohibited from making any catch-up contributions whatsoever. Not the standard $8,000 in catch-up, not the enhanced $11,250 super catch-up, nothing. The IRS final regulatory guidance is explicit on this point. The absence of a Roth option within the plan means the catch-up contribution avenue is entirely closed for high earners. That means a 63-year-old worker earning above that income threshold who is employed by a company whose retirement plan lacks a Roth feature loses access to the full $11,250. In the final year, they will ever be eligible for it. That opportunity does not get deferred, it disappears permanently. There is one additional trap that most people are completely unaware of. Your employer may simply have chosen not to adopt this provision. This is something the IRS final regulations published in September 2025 confirm without ambiguity. The age 60 through 63 super catch-up is classified as an optional plan feature. Employers are not legally required to offer it, even if they already permit standard catch-up contributions for workers over the age of 50. They may elect not to incorporate the higher limit into their plan design at all. The federal government's own thrift savings plan recognized that this would create significant confusion in workplaces across the country. That is precisely why the TSP developed a specialized weekly internal report called the TSPSO-09, a document whose entire purpose is to identify plan participants between the ages of 60 and 63 who stopped contributing before reaching the higher allowable ceiling. The TSPs built that safeguard specifically because they anticipated that payroll departments would make this exact mistake. If the federal government itself felt compelled to construct a protective mechanism against this type of administrative error, consider for a moment how many private sector employers are currently making the same mistake without any such safeguard in place. You cannot simply assume your plan has adopted this super catch-up provision. You need to verify it directly, and I am going to walk you through exactly how to do that in just a moment. There is one more dimension of this conversation that most people overlook entirely, and it involves the intersection of this rule with Social Security. If you are 63 years old, you are also standing at a pivotal crossroads in your Social Security planning. The earliest age at which you can file for Social Security retirement benefits is 62. However, if you were born in 1960 or later, your full retirement age is 67. Filing at 63 means accepting a permanent reduction of approximately 25% relative to the benefit you would have received by waiting until 67. This is not a temporary adjustment that reverses itself once you reach full retirement age. That reduction is built into every payment you receive for the remainder of your life. According to official Social Security Administration policy, benefits are reduced by 0.5% for each month you claim prior to full retirement age during the first 36 months, and by 0.5% for each additional month beyond that. At age 63, you are filing 48 months ahead of your full retirement age. The cumulative math produces a permanent benefit reduction of approximately 25%. This is where the super catch-up contribution becomes a genuinely powerful strategic instrument. By maximizing that $11,250 at age 63, you are constructing a financial bridge, a pool of accessible funds that can support your living expenses for additional years while you delay activating your Social Security benefits. Each year you postpone claiming past age 62, your eventual monthly benefit increases meaningfully. Delay all the way to age 70, and your benefit could be more than 76% higher than what you would have received had you filed at 62. Understood in this light, the super catch-up at age 63 is not merely about depositing more money into a retirement account. It is about purchasing time. Time that could translate into hundreds of additional dollars arriving in your Social Security check every single month for the rest of your life. Now let me give you the concrete steps you need to take, exactly as I promised. Step 1 is to directly confirm whether your employer's retirement plan has formally adopted the age 60 through 63 super catch-up provision. Super. Do not make assumptions. Contact your Human Resources Department or your plan administrator by phone or email and ask them the following question, word for word. Has our retirement plan been amended to include the Secure 2.0? Act Section 109. Higher catch-up contribution limit for participants between the ages of 60 and 63. Write that question down before you reach out. Use those exact terms, Section 109, Secure 2.0, higher catch-up contribution limit, ages 60 through 63. If the person you speak with is uncertain, you have a federally protected right under ERISA Section 104B, 4, to formally request a copy of your summary plan description. That document is the official governing text that defines precisely what your plan permits. Your employer is legally obligated to provide it upon request. If you are a federal employee participating in the Thrift Savings Plan, the good news is that the TSP has already incorporated this provision. They issued Bulletin 24-2 with comprehensive implementation instructions. Your payroll office should already be applying the elevated limit to your contributions. But do not take that on faith. Review your current contribution election to confirm that you are actually deferring a sufficient percentage of your income to reach the higher annual ceiling. Do not assume that any automatic spillover mechanism will get you there on its own. Step 2 is to determine whether the Roth catch-up requirement applies to your situation. Locate your 2025 W-2 form and look at Box 3, which reflects your FICA wages for the year. If that figure exceeds $150,000, then beginning in 2026, every catch-up contribution you make, including the super catch-up, must flow into a designated Roth account. That triggers 2 specific items you need to verify immediately. First, does your current retirement plan offer a Roth contribution feature? Second, has your employer's payroll system been properly configured to process Roth catch-up contributions correctly? If your plan does not offer a Roth option, you need to raise this with your employer without delay, because without it, you are legally barred from making any catch-up contributions in 2026. And if you happen to be 63 this year, this is your absolute final opportunity. This is not something you can comfortably table until the following quarter. By the time next quarter arrives, the window may already be closed. If your FICA wages fell below that $150,000 threshold, the Roth mandate does not apply to your situation. You retain the ability to make catch-up contributions on either a pre-tax or Roth basis, subject to whatever options your specific plan makes available. Step 3 is to act on maximizing your contributions before your 64th birthday arrives. There is no carry-forward provision. There is no extension process. There is no mechanism for making up what you did not contribute when you had the chance. Once you cross into age 64, the super catch-up is gone from your options permanently. If you are currently 60, 61 or 62, you still have meaningful time remaining, but do not allow that remaining time to create a false sense of security. reach out to your payroll department today about adjusting your deferral percentage upward so that your total contributions for the year will reach the $35,750 ceiling before December 31st. If you are 63 right now, this is your last eligible year without qualification or exception. Every paycheck that passes without the elevated contribution represents retirement. Savings you will never be able to recapture. Please do not allow this calendar year to expire without taking action. And one final point, before we leave this topic, if you yourself have already retired, but your spouse is still actively working and falls within this age range, make sure they are aware of everything covered in this video. This provision applies to any individual who is still contributing to a workplace retirement plan. It is entirely irrelevant whether they are the household's primary earner. If they are between 60 and 63 years old and have access to a 401k, 403b, governmental 457b, or thrift savings plan, this rule applies directly to them. Share this video with them today, right now before the moment passes and it slips your mind. Before I let you go, there is something I want to address directly and honestly. Rules like the ones we have covered today do not stay static. Contribution limits get adjusted annually. New regulatory guidance gets issued. The IRS releases updated provisions without sending personal notification letters to individual taxpayers. Your employer may not communicate these changes to you proactively. Your payroll office may not catch them. Even a financial advisor you trust and have worked with for years may not flag them in time. I want to be straightforward with you. Relying on YouTube alone is not a sufficient strategy for staying ahead of changes this consequential to your financial future. The platform's algorithm does not guarantee you will see my videos the moment they go live. You might encounter a critical update weeks or months after it was published. By that point, an irreversible deadline may already have passed. That is the exact reason I created a resource specifically designed to solve this problem. There is a link waiting for you in the description section beneath this video. It will bring you directly to the Global Senior Alerts Official WhatsApp channel. When you become a member, you will receive direct, real-time notifications the instant something changes that affects Social Security, pension policy, IRS regulations, Medicare, banking rules, or travel policies relevant to seniors. No algorithm filtering what you see. No notification buried beneath other content. A direct alert delivered straight to your phone at the moment it matters. And right now, when you join the channel, you can immediately download a complimentary copy of the Senior Benefits Protection Guide, a comprehensive resource covering the most critical deadlines, the most frequently made mistakes, and the precise steps required to safeguard your retirement income. It costs you nothing. It belongs to you the moment you download it, and it may represent the difference between learning about a rule with enough time to act and discovering it only after your opportunity has already passed. Click the link in the description, join the channel, download your guide. The entire process takes under 30 seconds. And then do one thing for me. Share this video with someone in your life who is between 58 and 65 years old. Send it directly in a text message. Post it to your family group chat. You may be the only person in their life who delivers this information to them before their window permanently closes. Robert never had someone in his corner who knew to warn him. But you do. And now, because you are choosing to share this, so will the person you send it to. I am Dexter. I do this work because I genuinely believe you are entitled to understand the rules that govern your money, not after it is too late to do anything about them, but right now while you still have the ability to act. Thank you sincerely for watching. I will see you in the next video.